The Reserve Bank lifting the cash rate.
1.4 million borrowers are at risk.
More rate hikes may be required.
From 0.1% in 2022 to over 4% today, the RBA's interest rates have been on a whirlwind journey, leaving many Australians wondering what's driving these decisions, and more importantly, when will we see a shift in this upward trajectory? In just over a year, we've witnessed a series of consecutive rate hikes, a move that's not just about numbers on a chart, but one that's deeply impacted households, businesses, and the very pulse of the Australian economy.
Today marked a 12th Reserve Bank rate rise in 13 meetings.
Established in 1960, the RBA isn't just any bank. It's Australia's central bank, responsible for the country's monetary policy, issuing banknotes, and ensuring the stability of our financial system. At the heart of the RBA's decisions is a little thing called inflation. Think of inflation as the rate at which the general level of prices of goods and services rises, causing the purchasing power of currency to fall. In simpler terms, your dollar today might not buy you as much next year if inflation is on the rise. But why should we care about inflation? Well, moderate inflation is actually seen as a sign of a growing economy. But when it's spiraled out of control, it can reduce savings, create uncertainty, and even lead to economic recessions. So, where does the RBA fit into all of this? To combat high inflation, central banks like the RBA might decide to increase interest rates. Higher rates means borrowing becomes more expensive and spending slows down, which in turn can help cool down an overheated economy. In the past year, we've seen a wide range of challenges. Global supply chain disruptions, increased demand post-lockdowns, and external economic pressures have all played a part in pushing prices up. The RBA's response? A series of rate hikes to try and keep inflation in check. Now, a year later, the question on everybody's mind, when will it come to an end?
Things are moving in the right direction, but it's still too early to declare victory.
The four big banks have also weighed in. ANZ is hinting at a prolonged pause with potential easing only by the end of 2024. Commonwealth banks are a tad more optimistic, pointing to early 2024 with a hopeful drop to 3.1% by the close of the year. NAB sees one more hike, peaking at 4.35% around November. But they're also optimistic about a reduction come August 2024, targeting a more palatable 3% by early 2025. And Westpac? They're playing it close to the chest, suggesting a potential cut in the September quarter of 2024. The banks aren't the only ones weighing in though. Diverse voices from the financial world have weighed in. Mark Crosby, the Director of Bachelor of International Business at Monash, warns of a potential rate rise if inflation doesn't simmer down, yet he's eyeing 2024 for potential cuts. Leanne Pilkington, CEO of real estate group Lang & Simmons, is also circling mid-2024 on her calendar. Tina Teng, market analyst for CMC Markets APAC in Canada, is observing the global stage, noting that international decisions, especially from powerhouses like the US and China, could influence the RBA's next move. So, the consensus seems to be that late 2024 to early 2025 might bring the relief many were yearning for. My advice, investor to investor, stay informed, keep a close eye on global economic trends, and always be prepared to adapt. In this ever-changing financial landscape, flexibility and foresight are your best allies. See you next time.